What is up,
What's
Omar? In
happening?
the
What's
house.
happening?
Let's do this. You like that intro music?
I need the intro music to kind of amp myself up when we do these.
Yeah. Yeah. Are you gonna start dancing?
I was dancing a little bit, but then you stopped me. I don't know. Don't
Uh,
disrupt my flow,
don't do
man.
that. Don't
Come
do that.
on,
Don't
come
do that.
on. Let me be myself.
Don't do that. Don't do that. Here, let me turn down the. So, what's up, Omar? Happy Friday.
No, it's not Friday,
Friday?
baby.
Yeah, it is
Saturday.
Saturday. No, it's Tuesday.
Saturday.
It's Tuesday.
Saturday morning.
Is it Friday or Tuesday or shit? I don't even
Dang.
know anymore.
That's how
Did
you
I say a
know
bad
you're.
word?
That's how you know
I'm
you're
sorry.
overworked, my friend. You
I,
don't even know what day it is.
I am not overworked. Hey, so what's new on your end? What's good? Tell me
Man,
something
I had
good.
an awesome week. Got to do a lot of cool stuff. You want to talk about it?
Yeah, tell me.
Okay, okay. So let's see.
Don't take half hour, all right? Because
All right, I'll
everybody's gonna
keep
get.
it short and sweet. My goodness. All right, so I'm doing an open house next weekend on Saturday. I want to go speak with the listing agent. We're doing this open house extravaganza. We're doing a lot of content for it. Up a little bit. All right. There are these awesome row homes, 1,600 square feet out in Georgetown. I'm looking forward to that. We're really hyping it up. I actually got together with a few other realtors. We did this awesome video shoot, and it's actually nice doing content with other folks other than just yourself. So
Mhm.
that was awesome. And then yesterday I did
Yeah, it's always nice to talk to other people, right?
it's nice to do content with other people
it,
because
it,
you kind
it's
of
nice to socialize with people.
oh yeah. Oh yeah.
Hey, we tend to like stay indoors. And are you an antisocial or a
I
introvert or extrovert?
I'm a hybrid.
You're a hybrid.
Yeah. I like people. They do give me energy, but I can get overstimulated and like I need to be by myself for a while.
Whoa. Overstand. Why are we talking? Why are we talking? No, this is a PG or a G rated
It's funny where your mind went when I said
podcast.
stimulated. So I
Yeah,
don't know where
this is weird. This is getting weird. You know what? Let's just move on, okay?
you're making it weird. You're making it
Hey,
weird.
how about that meetup that we went to
Oh, that was another good one.
on
Yes.
Monday or Tuesday or Wednesday? I don't
Yeah.
even know because
Yeah.
I thought today was Friday.
That one was for real estate investors, and I was thinking I was gonna meet more realtors,
I
but
know.
no, I met
I
everybody
know.
but realtors, which was
Yeah.
awesome. I met some really good folks, and they put it on. It was actually really well done. I was impressed.
Yeah, I agree. That was on Meetup. It was an investor group, and it's you can find it on that Meetup app,
The
right?
meetup app, yeah,
Yeah, I
yeah.
found it there. Just type in investor group Meetup Austin, and it's a very well put together, very good crowd. You don't have because I'm a mortgage lender, you're a realtor. It wasn't a bunch of realtors and a bunch of lenders because they're awesome, but come on,
That
like
was very noticeable right away. I think I've been dropping the ball. I've been going to too many of those, and not enough of just
just
these, where
normal
you
people,
meet normal people
normal
that have normal
mortals.
jobs, and you're not talking, but they like talking about real estate. That's to me
Yeah,
nice. They like
yeah,
talking about real estate, and they're normal people.
yeah. That's what made it so much fun.
Mm.
So what else? How about the market?
Man, so are we talking about like a little market update for Williamson County now? Because I have one more thing I wanted to say, but we can go right
All
into
right.
that.
You can talk about it. Yeah, yeah.
Well, I just want to shout out David Weekly Homes because we shadowed a home inspector and we looked at the four
Mhm.
different phases of pre-construction. It was just fun. Learned a ton. I can't wait to do another one because it's just there's so much to absorb. But luckily, this
Mhm.
guy named Clayton, he was a home inspector that was putting it all together and just the instructor, and he was just super knowledgeable. It's just nice to kind of get that wisdom, and you just look at homes completely differently because now you understand kind of what you're looking at instead of just it being just two by fours, foundation,
Yeah,
walls,
so you're learning a lot about it. And that's
Yeah.
important,
That's super important.
especially for buyers, right? Because buyers, you walk into a new construction, you're depending on them, on the builder, to make sure everything is
Well,
good. And the builders, they're just looking for the city inspection to pass, and that's it. So the
certificate of
yes,
occupancy, yeah.
yeah, certificate of occupancy. So that's where a good inspector, a good home inspector, is crucial.
One thing that I don't think people are aware of is that when they think of a home inspector, they think of it just one time at the end. But if
Yeah.
you're buying new construction, if you do it early enough, they'll inspect it before they pour the foundation,
Mhm.
before they do before they install the insulation, when it's just the frame, and I think two more inspections. So they're with you throughout the whole step of the way, just
Mhm.
checking the the construction, the build, if it's on par with like so you're getting a good quality home,
Yeah.
right? And that's why I give it up to David Weekly because they actually allowed a third party. So this is someone that doesn't work for them
Right.
that's teaching us about this.
So wait. You said David Weekly. Is that a
Mhm.
person or is that a
That
builder?
is that
What
that
are
is,
the
that is the
build?
name of the builder.
Oh,
They're
okay. David
yeah,
Weekly builder. So you're
mhm,
talking about a builder. So
a
yeah,
builder.
that's good for them that they allowed for a third party inspector or they encourage it because the other builders I'm sure allow it, but they don't seem to encourage it. And I tell you from personal experience, they don't. So let me
Digress.
actually let me show you. Want to show you or tell you? I think I should tell you about the markets. They were kind of wild. They
Yeah,
just came to
let's
me.
hear from you. Tell me your perspective. What are you seeing?
Like the markets, from my perspective on the mortgage side, are very wild. There was a lot of things happening this week in terms of inflation. That's really the big news. I mean,
Mhm.
for us in the mortgage industry, inflation is what
Do
moves.
you get tired of talking about that?
I do not. I
Okay.
actually love it. It's yeah, I love talking about it. I can go 2 hours on this, but I promise I won't. But inflation drives our interest rates up and down.
Okay.
That's what happens. Inflation goes up, interest rates go up, and that's to. I'm gonna say this in the most simplest or basic form. Uh, Inflation goes up, the interest rates go up so that it tames inflation. There's so much more to that, to what I just said there, but inflation goes up, interest rates goes up. That means less spending. Inflation comes back down. If interest rates go down, well, you can spend more because the cost of money is lower, so you get to spend more. Well, if there's more people spending, there's more demand, and then the interest rate or inflation goes back up, and then it causes the rates to go up, and yeah. So that's how that works. So now, right now, and for the last 1 year, the inflation, I mean, it hit almost what 11 or 9%. I mean, it went through the roof. The PPI went over 10%, but the CPI, which measures inflation, that went up. I mean, it peaked March or when did it
Wait,
peak?
I'm sorry to interrupt you, but you said two things that I wasn't sure what you're talking about. You said like PPI and CPI.
PPI and OPP. Are you down with OPP? No,
What
P
is that?
okay, so PPI, no, sometimes I love talking about this so much that I just like go through it.
Yeah,
So
it's the Marine in you. You're throwing all
so
these acronyms out there.
acronyms. So CPI,
Hmm.
Consumer Price Index.
So that applies to who? People like,
That's consumer. Yeah,
so I'm a
that's
consumer, right?
you're a consumer. You're
Okay.
buying, you're buying food, you're buying energy, your oil, gas.
So that's everybody that
That's
buys stuff.
everybody that buys stuff. That's
We're consumers.
the
Okay.
consumer. Okay. So PPI is a producer price index, which is the inflation that the businesses at a wholesale level feel and have. So typically it's a lagging indicator. Like if you, or I'm sorry, not a lagging indicator, a leading indicator. So if the PPI, if the producer price index is going up, that means that the consumer price index will be following because if the manufacturers, if the businesses pay more for the goods, for the raw goods to create whatever it is they need to create, well, guess what? The prices are going to go up to the consumer. So that's how those two correlate.
Okay, hang on a second. So producer price index, that's what you said, right?
Mm-hmm.
So producers, another way to think of that is like the business owners' businesses.
Yes.
Okay, so if
Yes.
their costs go up for whatever reason, like maybe labor, raw
Supply,
materials.
shortage of supplies.
Okay, so if their costs go up, then the way it works, like they usually transfer that cost to us, the
They
consumers.
Eventually it gets there.
So that's why,
Or they could take a hit on their profit margins, but
it's important to look at that as it relates to like inflation or interest rates for a reason.
right. So then if you know that the producer price index is heading down, then you know next month that the CPI, the consumer price index, will be heading down as well. And if the CPI goes down, then rates are going to follow. So mortgage interest rates will follow.
Okay, so if we see those two indexes, right, the
Yes.
consumer price and the producer, like going, if we see a downward trend,
Yes.
that's good for interest rates because that means inflation is maybe going down. Is that what you're
Yes,
saying?
exactly. And if inflation goes down,
It's good for interest rates.
mortgage interest rates go down.
Okay, but not super dramatically. We're not talking about like where it was like 2%, but we're talking about maybe.
Well,
what are we talking about
actually,
here?
let me pull something up here.
Yeah.
Because actually pulled up. I was looking at this a little bit ago. Let's see, and let me pull up.
Are we going to be on the screen now?
Yes,
Oh,
yeah.
yeah.
Take a look at the screen.
Let's go.
So,
Let's go on the internet.
so into the interweb. So check this out. This is the consumer price index. There's a graph dating back to 2003, and we don't really need to look at that too much. But let's look at right here, May of 2020. Look what happened here.
So that's
0.6
pandemic.
That's right around the pandemic. I mean, when the pandemic hit, the inflation went down to pretty much 0.1 because nobody was spending, right? So then you'll notice that as the supply shortages became evident, they had an effect on inflation, and it just kept driving the inflation up to a peak of 9.1 in June of 2020. And then
June of 2020? No, June 22.
I'm so sorry. June of 2022. I'm so glad you're here.
9.1.
So
wow, that's
so 9.1. And then it started trending down, and you can see the trend. It's falling. It's just going down. And the one that just came out yesterday or Friday or what was it? Wednesday, CPI report came out. It came in at 5% year over year. So, or month over month. So it is dropping. It is dropping. And yes, we're not at the 2%. We're ways out, but I mean, we're trending down. And that's what I wanted to illustrate with this graph. Now, this is the consumer price index. Let's quickly look at the producer price index.
Well, let me remember that number. It was like 5% for last month. Okay.
5% for last month. So let's look at the producer price index. And this, I mean, again, it goes back to 2011 and it fluctuates and so on.
Oh, look at that mountain.
And then this is again February, March of 2020, and it's very similar to the consumer price index, as you can see. And this one peaked at 11.7. So it kind of leveled off for a little bit. In June of 2020, it started falling and falling and falling. And this one is right at 2.7%.
Okay, so for March of this year, 2.7. So what was February? I'm curious.
2.7.
What was February?
February was, let me see if I can pull this up.
So sensitive, huh?
It is.
4.9 to 2.7.
Yes.
That's pretty dramatic.
That is very dramatic. So
what the heck's going on here? That's a big down.
Right. So this being a leading indicator, what do you think is going to happen with the consumer price index moving forward?
It's going to mirror it, maybe?
Yeah, it is. Well, there's only one reason it wouldn't, and that's because now the businesses have a lower cost, lower inflation.
Their costs are going down.
Costs are going down. So the inflation is down from their perspective, from their side. So if it's cheaper to produce their goods, are they going to pass the savings onto the consumer, or are they
to them, right?
Or
it's business, they're private, they can do whatever they want.
Exactly.
Yeah, okay.
So We'll see. I don't think it'll drop to 2.7%, but I think it will drop maybe another 1%.
Can I tell you what I saw the other day? Like an article I was reading
What's
about
up?
kind of related to this
Yeah.
about
Yeah.
this is going to look bad for business, but there is almost not discrepancy, but like another outlier, another layer to this, where even though we're seeing the cost for businesses going down, why are we still seeing prices at the grocery store? All that still, like, it feels like everything's staying the same, if not going a little bit higher.
Right.
And then the article I was reading, like, that's like corporate greed, right? So now,
yeah.
I mean, the article is kind of summarizing, because especially publicly traded companies, they have to report their financials, and they just you're seeing all this profit margin,
Right.
like record breaking.
Yeah.
So it's like, what the F, you know? Like, are they gonna keep milking this cow to see if they can keep charging us, the consumer, these prices? Because now we kind of maybe got used to them, and like just try until demand completely falls off, and then they'll do their adjustment.
Right. So they want to crush the economy in order for it to. Yeah. I don't know.
Damn.
I don't know. That's a very good observation. And I'm not sure because there's so many variables, like the whole SVB bank that collapse. That should have caused a lot of changes within the mortgage industry, within the financial system, that would have caused the rates to drop like right away. And I'm not going to get into those details because it's related to the bond market, treasury, and something called the reverse repo operations, or reverse repurchase agreements that the Federal Reserve has with the institutional banks out there, like Citi, Chase, Bank of America, all the big ones. There's like 15 or 60. I forget. I can't even remember what day it is. So I forget the number of banks that are part of the gangster group, or bankster. I call them banksters, because if you're part of that group, then yeah,
you're bankster.
You're a bankster. If not, like SVB Bank, then you're not part of it. And guess what? You collapse. You collapse. But the FDIC did put a backstop on that, and that's so unfortunate, because they didn't lose. That they changed the rules, and yeah, they changed the rules, and it saved certain types of investors. It didn't save the regular
Joe Schmo.
Yeah, the regular consumer. It saved the corporate. It saved we're talking about the 1%ers. So enough on that. I'm not going to go on that.
I think it's crazy that was like the headlines for like a few weeks. Now I haven't seen anything about.
Yeah, it's done. It's quiet.
Yeah,
it's quiet.
Yeah.
So now I'm thinking that the rates are going to drop, and I feel pretty confident, unless the government, unless the Federal Reserve or somebody comes in and changes the rules and the guidelines, or backstops something. But if things as is right now, watching the producer price index and the CPI and the consumer price index, those are indicators that the rates are about to plummet. What effect is that going to have on the market? How do you see that? Do you think that's going to bring more buyers into your side, into the real estate side, and the buyers that are there right now, are they going to get off the fence? Or?
Well, before I answer that, I was going to ask you a question first.
Yes, sir.
So kind of like predicting, because we're going to summer, which is typically the height of the market when it's the most busiest, right? So I know a lot of people, I guess maybe been strategically waiting for the summer to go home shopping. So with the next couple of months, what are you foreseeing as far as like the interest rates? Are they going to drop a little bit, maybe stay the same, so that we can see if like we're going to see more buyers? Because I know the interest rates, because that correlates with like what their monthly mortgage is going to be, is going to depend on whether they go out and go home shopping or not. So what do you think is going to happen for the summer with rates?
Well, I think a lot of buyers, they're sitting on the sidelines. They're waiting for the rates to drop in order to rush to buy. So if the rates drop, I want to say 4.5%, I think we're going to have a massive influx of buyers, and we're going to get back to the bidding wars, which a lot of buyers, they're not understanding that part. So now the price of homes are going to go up. And
But realistically, 4.5% is a lot. What do you expect to see
I know,
for
four and a
like
half.
maybe for this summer? Like maybe go down a whole point, a whole percentage point, or maybe down
Five.
because
Yeah.
it never drops that crazy, right? It's usually like little bite-sized pieces that they kind of chip away at, right?
We would hope that it doesn't drop that fast, but
So what's it at right now?
it's at on average 6%,
6%.
six and a half on a
Maybe for
conventional.
the summer, what do you think? Like 5 something?
I'm thinking 5.25.
Okay.
So I'm thinking about a 1%.
That's 75 points, right? Look at me.
Yep.
Look at me.
0.75.
Okay.
Yeah. 0.75.
Yeah.
Yeah. 0.75. So if it gets into the low fives, I think we're in business. If it drops beyond that, it's on. I mean, it's going to be insane.
I hope it doesn't drop that crazy, because if it drops that crazy, then we're going to see another kind of like repeat of just an influx of more buyers, and then we're gonna, the sellers are gonna have their way and not have to, skip inspection, all that. I don't want that to happen. I rather it just be incremental, where it's,
Yeah.
Go ahead.
Yeah. No. You make a good point. Now, it just hit me too. Like the Fannie Mae, they added extra fees for second homes. Like if you're buying a second home, there's additional fees. If you're doing a cash out, there's additional fees. It gets kind of expensive. So, and I know Freddie Mac, I believe, I haven't confirmed, but I know they probably followed suit. So they basically copy Fannie. They copy each other. And the reason let me back up a little bit. The reason I bring up Fannie and Freddie Mac, because most of the loans are securitized by Fannie or Freddie Mac nationwide. So you buy a house, and I'm the lender. Well, I take that promissory note, that IOU, and I send it to Freddie Mac or Fannie Mae so that they can reimburse me for that $500,000 purchase plus a premium, right? Whatever the premium is at that time for that interest rate. So that's how that works. Now, it has to meet their guidelines. If it doesn't, then we can't go. Now, if they say, well, we're going to put a fee on second homes, on cash out refis, on so on and so forth, well, it's going to deter clients or consumers from buying a second home, buying or pulling out cash to buy properties cash. So what is that going to do? It's going to actually help the first time home buyer.
That's what I was thinking.
It is going to help the first time home buyer get into their home. And otherwise, investors, especially in this area, remember, there was 80. I made an offer on a house here about a year and a half ago, like an investment property. We had 83 offers, 83, 62, 50. They were never under 50. And it was all cash. And I was financed. I was doing like 30% down in this case. And there was there was not even competition. Now, me with 30% down, I didn't even stand a chance. Now imagine the VA home, the veteran buying with 0 down, or the first time home buyer buying with 3.5% down FHA. They don't stand a chance. Yeah. Investors are just gobbling these properties up. And on that note, man, now I'm taking over this. It's supposed to be you sharing as well, but let me tell you about the California Dream for All program, because in California that thing was trending. It was all about the California Dream program, and that was where the state gives you 20% down. So let's just say a 20%. Yeah, let's just say $400,000 home. They'll give you $100,000 down so that you could put for a down payment. That eliminates the need for mortgage insurance. Okay. And then you get a slightly better rate, and all is good for that buyer. And there's obviously very strict restrictions. Like the guidelines are very, very restrictive, but nevertheless, it's a great program. They allotted $300 million for this. Okay. $300 million. And that program was done in 7 days. All the $300 million was used up because everybody ran to it. Now, everybody's looking at the benefit to the home buyer, which is great. Okay. Now, you look behind the scenes and you see what this program really was all about. And I think it was, from my perspective, it was an investment strategy for the state of California, because $300 million, where do you put that money that is the safest place and earns a ton of money, earns up to, God.
Or like taxes for the state? Is that what you mean?
No, not even that, because check this out. Let me give you the details about this program. They'll give you $100,000, but there's a shared appreciation. You got to pay 20% on that, of the appreciation of the home moving forward, if you want to buy, if you want to sell or refinance, or sell, if you want to sell. So let's just say you stay in that home for 10 years, or even not even that long, 5 years, and you go to sell it and it's worth, let's just say, double, just to make things simple. So it's 800,000. Well, you got to pay 800. You got to pay on the 100,000, whatever, you got to pay that back. And then 20% of that down payment that they gave you, 20% of that money that they gave you. So if it appreciated 400,000, you're going to have to pay like $100,000.
Wait. So you're saying you're paying back the initial 20% that they gave you for down payment.
Right. So that 100,000.
Okay.
And then you got to pay 20% of the appreciation.
Okay.
So, 20% of the appreciation. There's a formula. So I worked out the math, and it's about 100,000 if it doubles. Right now, comes out to about 18% return on the investment, on the $300 million investment. And that's the point I'm trying to make, is the state of California, you got it. State of California said,
I know that's,
you know what, $300 million, we can't put it in the bond market because it's only giving us, let's just say, 5%. Inflation is X. So no, let's put it in the stock market. Well, it's too volatile. Index fund. Well, I don't know. Well, let's just invest it in real estate, because we know that's an upward trend.
They're already forecasting or have pretty good predictors of, like, if they give us money away, then 18% is pretty close to what they'll get in return for that investment.
Yeah. Me and my coworker, we were working out some numbers, and yeah, it's up there. I mean, even if it's 50, even if it's 10%, let's just forget that. Okay. Let's just go 10%. That's an amazing return on $300 million. And I haven't looked through the paperwork, through the CCNRs or whatever documents they pop in there, but I bet there's a clause in there that they have the first right of refusal if the home were to go into foreclosure. I know that verbiage has to be in there. Maybe not, but
I had heard about that too. I just didn't know it was capped at that 300 mil. That was news to me.
Yeah, 300 million.
That makes sense.
It went like that, 7 days. So yeah. So why am I telling you this story? Is because if the state of California feels that the real estate market is getting ready to take off, we know. I mean, they're putting $300 million. They're betting $300 million that it's going to take off. Why are our consumers, why are our buyers, especially our veterans, sitting on the sidelines waiting for the crash? Because their neighbor or somebody else that probably doesn't even own a home, the compadre is like, no, you wait, because the market is going to crash. You'll see. They have nothing to base it on, and clock is ticking, and pretty soon a lot of people are going to be priced out, and they're going to be stuck in that rental cycle, and rents are going up, and inflation. I mean, inflation really affects rents.
Oh yeah,
because bam, you pay more, and once you're in your home, your interest rate doesn't. I mean, that your payment is fixed as long as you get a 30-year fixed.
Wow.
So that's my take on that. Sorry, I think I went a little too.
Well, how are we doing on time?
Far on that. I don't even know, but doesn't matter. No, actually, it does. We're getting pretty close.
So I really want to circle back and just talk some numbers about Williamson County before we sign off.
Hell yeah, let's do it.
Okay, so the numbers came out for last month. So for March of 2023, right? So the median price for Williamson County was 425.
425.
So to give you some perspective, January of this year was 438. So 438, 425. So a little bit decrease. I'm still seeing, I'm just going to summarize. Instead of giving you a number, I'm going to summarize so you guys can get some months of inventory is trending upwards.
Okay.
Right? The crazy thing is that the days on market is high, right? Well, more normal. It's just, I say it's high because I'm still used to looking at 20, 30 days on market. Now it's going up to 82 days.
Oh.
Right. Days on market. That's just days on market. Days to close is 41. So total is 123 days for March.
Okay.
So that's giving plenty of times for sellers to sell and for buyers to shop around, right?
Right.
And now we're kind of going to this market where if you are not pricing your home appropriately, then that's where we're sitting longer days on market.
Okay.
Right. And I hear it from realtors, my realtor partners and friends all the time, both sides. They price it strategically where they're not chasing the market, so they get into multiple offer situations. And then you have other realtor friends that are like pricing it maybe a little bit too high, or just trying to abide by their clients' needs. And then and now it's just sitting and sitting.
Oh,
and then once it goes for like more than 30 days, this is just going to continue to sit because people just psychology.
Yeah, it's stagnant. Yeah, something's wrong with it.
Something's wrong with it. Or why so many people passed it over, right?
Because it wasn't priced right. So
but inventory is upward trend. Median price is still fluctuating around the 400s as a median for Williamson County now.
Yeah, this is Williamson.
And the other interesting note was, so active listings 2,300, closed sales 970. I'm rounding numbers here. So that puts us at an absorption rate of 2.4.
Okay, what does that mean?
So absorption rate.
I'm just a lender.
It's a good way to measure supply and demand. So that's saying in 2.4 months at the current sales rate, all of our inventory would be gobbled up in 2.4 months.
That's actually healthy though. 2.4, 3% is healthy, right?
6 months is typically healthy, right? So we're still, if we're under 6, we're technically in a seller's market still.
Wow.
Right? But again, it's for real estate's hyper local. We're talking Williamson County. So that's a big area to cover, but it's kind of gives you a little bit of perspective, right? We're still seeing months of inventory slightly increasing, but we're also seeing the sales rate kind of keep pace with that. So houses are selling,
so they're moving,
but we are keeping up with new construction to kind of replenish. So we're not seeing the 0.01 or the 0.05s like we were in the past years, right? Where it was under a month of inventory. Now we're seeing 2.5, like a little bit going upwards, which is good. That's good for us, right? Because that gives more buyers more options to search for homes. And even though we're still in the seller's market, right? Keep in mind that, but we are still seeing an increase in inventory.
And that's good. That's good because there's options. This is good.
Yeah.
So good time to buy. It's getting, well, hold on. Let me back up because one can always argue that it's always a good time to buy, right? And you know what? We're super biased because we're in the industry. Yeah, buy. But here's the thing. There are times when I suggest that you do not buy as a consumer. The first thing you need to look at is your job. Is your job secure? If your job is secure and you feel confident that it's going to continue and it's on an upward trend, hey, yes, that's a first green light. Yes, go. If that needs to be there first and foremost. Okay. Then if you're not happy with your existing home, or you don't fit, or you have a 2-1 or 2-2 townhouse or apartment, and you have a new addition to the family, now it's going to be you're going to have a new baby. God, maybe you're blessed to have twins. Now what? You're not going to fit in that 2-2 condo or house. That's a good time to buy, but you got to make sure that your job is solid. You can't just jump into it. So employment is number one. If you feel confident, then police officers, people, nurses, paramedic, any of those industries that have a lot of job security, I say yes. Now, if you don't work in those areas and you have a large family, then yeah, then you're confident that you will be able to make it happen, or you house hack. You got to be able and willing to feel uncomfortable to buy this home, meaning
Sacrifice.
You rent a room, you get a roommate, that's what's house hacking. You rent the room, you rent the master bedroom, and you live in one of the small rooms. But guess what? They're helping you pay that mortgage. They're helping you pay that principal down. They're helping you obtain that appreciation. And in the long run, after 2 years, 3 years, you're winning.
Yeah.
You're winning. So yeah, these market conditions they're very well balanced. I thought they were worse. Thanks for sharing that with me, Omar, because I thought it was worse. And
I want to add to what you were saying.
Mm-hmm.
The job has to be good. You have to be happy with that, right? Because now you have this mortgage you have to pay, and that's something you don't want to mess up, right? And you want to make sure your debt's in check, right? Because if in light of inflation and everything, credit card debt is on the rise. Everyone's been borrowing money just to get by, right? If that's out of whack, that's going to affect your interest rate, right?
Yeah.
Your credit score is going to affect your interest rate. So when we say it's a good time to buy, we're only speaking to the people who are on the fence, who are ready and just waiting for a crash to happen. But people who are not ready because they need to fix their finances, they need to make more money to qualify for the home that they want, right? But we want to get you on the right path, right? You don't have to go at it alone. I think I can empathize with this. Is like we put ourselves in an island where we think like, hey, I don't feel comfortable talking to anybody until I do, until I feel I'm in line with everything. But it's like, hey,
it's never going to be.
That's not how I want to do business, right? I don't always want to, we can assist and build that relationship. So when it's go time to buy a house, I kind of know you're ready.
It's go time.
Yeah, we can knock it out, and that way we get to know each other and really get to see that's the biggest thing, is like when you meet somebody, how do you build the trust and rapport so you can really figure out what their needs and wants are, so you can get them in. Go ahead. Were you gonna say something?
Yeah, you just I just ask.
No,
people ask people, hey, what are your goals? Why are you looking to buy?
Yeah.
Why are you looking to move? Is it the rent? Is it the commute? Is it the addition to? Is it a pesky neighbor? Yeah, and for the most part, people want to share that with you. That way you can help them better. I mean, that's good, because you can help them better. If you know exactly what they want, or have a decent idea of what they want, then you're able to take all of your knowledge and come up with the strategy or a solution. Ooh, look, strategy, power, balance, knowledge, work, organization.
This was a long podcast, but I like what we talked about.
It's actually not that long. No, it's not that long. It's good. It flowed. On that note, I think we should call it. Do you have anything you want to add?
No. I said it all. I think ending it off on strategy was perfect.
Strategy, mission, future, motivation, leader, decide. That's pretty cool. That was a gift, right?
No,
that was a gift.
I know it was new, but I didn't know it was a gift. Okay,
that was a gift. So it has a lot of meaning. I love it. All right. On that note, everybody, thank you so much for joining us today. We appreciate you. We love you. And until next time, peace out.
Yeah. Later.